Let's get in some fundamental perspective. We have Mayuresh Joshi, Fund Manager, Angel Broking, joining in to take us through a couple of his stock picks. Mayuresh, hi. Thank you very much for joining me this afternoon. Before we talk about the markets, wanted your sense in terms of the banks. Up 18% for SBI this week. ICICI Bank up around 20-odd%. A little bit of profit booking on the Bank Nifty, but that's also recovered from the day's low. Any formidable expectations from the Gyan Sangam 2, which is kicking off today?
Morning, Ekta. Clearly, I think what has happened with the banking industry as a whole and the asset quality issues that we have seen in the quarter gone by, I think those issues might still persist that a lot of managements have put forth. But I think a lot of positives will probably come through with RBI announcing the Basel III norms, probably readjustment of the revaluation reserves and the forex reserves against your tier 1 capital. I think that's going to boost the capital adequacy for a lot of these firms. The bank bureau that is coming through, I think that is going to also aid a possibility in terms of how the asset quality pressures will ease over a period of time. And again, I think these meetings that probably take place give a structural way on how to approach a lot of the structural issues that these banks are facing. So clearly, I think I'll have a stock-specific approach within the PSU pack. I think State Bank is something that we've continued to like. I think the kind of drubbing that the stock received, I think it is better placed compared to the others. So I think the capital adequacy is still very, very strong. The CASA ratio is strong. It's an extremely strong franchise. So State Bank would remain one of our preferred picks within the PSU banking universe.
Okay, Mayuresh, hi, good morning. What about aviation names? We have seen good gains today in names like Jet Airways, SpiceJet, and they've corrected after the last rally. How would you approach them?
Morning, Anuj. I think exceptional set of numbers posted by Jet and SpiceJet. Interglobe disappointed probably with the couple of reporting quarters that reported, and again I think the delay in the receipt of the A320 Neos. Having said that, probably I think a lot of the positives in terms of our margins in panned out, specifically in relation to ATF prices correcting, crude expected to stay at low levels, have probably gotten to the price. The passenger load factors have seen some amount of increase over a period of time. And again, I think the operational efficiencies are very well laid out. However, I think debt still remains and leverage still remains an issue for companies like Jet and SpiceJet, though the performance has been exceptionally good for SpiceJet over the last 3 quarters. So again, I think at this point of time, largely neutral, wait for declines. Whether that decline will come, I think time will tell. But again, I think you have to be stock specific. I think it will be the SpiceJet on declines or Interglobe Aviation.
Okay. Well, two-wheeler sales were good for this month. Mayuresh, TVS Motors, you like that stock?
Oh yes, Ekta, and again I think if you look at how the performance has been for the large part of FY15, it has actually outgrown the industry volumes. It actually grew around 20% when the industry grew 9%. Now our own take is with the kind of launches that it has got and the kind of sales acceptance that a lot of its models have received, Jupiter, Star City Plus, Scooty Zest, our own estimates suggested 10% volume growth over the next couple of years. Clearly with increase in geographical presence, with operating leverage benefits kicking in because of the increase in volumes that you'll probably see, realizations expected to be much better because of the non-moped increase in sales. I think all that is going to abet EBIT margins in a significant manner. So our own take is EBITDA margin should expand over the next couple of years by around 220 odd bips to around 8.3 odd%. And if you look at the kind of cost optimization that the company is going through, along with benign input costs, our own take is that there should be a reasonable amount of top line growth. So 16% is what our belief is over the next couple of years on a CAGR basis. Probably emanating into a 53% kind of a bottom line growth. Valuation is not too demanding at this point of time. The BMW type tie-up is also going to aid the company in a significant manner. What launch happens over the next few months is keenly watched. So I think TVS is something that we probably prefer at this point of time with a target of 330 over the next 12 months.
Okay, IT is weak today, barring an Infosys, of course. What's your house call on IT, and what are the stocks that you like?
So clearly, I think the currency movement, Anuj, I think does create some amount of headwinds with kind of headwinds that you're probably witnessing even in terms of how Q4 will pan out in terms of discretionary spending. I think these are known facts for the market. With large cap IT is something that we continue to prefer. Our own take is that a lot of these large cap IT companies have done a lot of client mining exercises that is going to aid the top line growth significantly over the next few quarters. Secondly, I think if you look at the utilization levels for a lot of these IT companies, there is sufficient headroom for companies like Infosys to actually show an improvement of 300 bips or in utilization levels. HCL Tech has decent utilization levels. The TCV wins in excess of $1 billion for HCL Tech augurs well for the company. Valuation again not too demanding. So our own take is that it should be a reasonable cross-currency growth. Again, if you individually break it up across product segments and even in dollar and rupee terms, it should be much better than what NASSCOM has predicted. So clearly, I think large cap IT is something that we prefer. Infosys, HCL Tech would remain our top picks.
Okay. Have you looked at REC and PFC? Both those stocks are fairly active today, and they would eventually be beneficiaries once the Uday scheme is completely implemented. Your sense on both of those?
I think there would be some beneficial impact coming through, but again, I think if you look at how the Uday scheme has been positioned, you will definitely see a fall in yields coming through. So I think that amount of, that component of for reduction in yield should more or less be adjusted at this point of time in terms of future earnings projections for both these companies. Asset quality pressures probably a little bit on the higher side, specifically in terms of their private exposure that they've taken. So the provisioning has probably gone up. In terms of valuations, extremely attractive at this point of time. So yes, I think there are some positives, there are some negatives, but whether they'll show huge amount of outperformance from the current levels, I think it will be numbers that will probably indicate the fact. So I think Q4 numbers, Q1 numbers would be indicative on how the Uday scheme is getting implemented, how the SCPs are probably getting affected in a positive manner, and that should have a positive rub-off effect. The caveat being, I think the yields will soften in terms of the Uday scheme for both REC and PFC.
Any mid-cap stock idea that you like, Mayuresh?
Again, Anuj, I think with the thrust that the government has given on the infrastructure space, the roads and highways space, the allocation of 57,980 odd crores towards roads and highways is a very positive development, followed up a lot of these EPC and road players. So I think EPC as a theme is something that I've been liking for a length of time. I think within this space itself, PNC Infratech is something that we continue to like. I believe the numbers that the company projected in the quarter gone by and the 9 months reflection of top line has been quite impressive. The EBITDA margins at 12.5% in the quarter gone by were equally impressive in our opinion. The order book of around 3,775 odd crores gives a B2B visibility of close to 2.1 times trailing numbers. And again, I think the kind of order wins that the management really expects over the next few quarters of 2,500 to 3,000 odd crores should augur well for its EPC business. So I think we're valuing the core EPC business at 14 odd times, which values the core EPC business on a SOTP basis close to 450 to 455 odd rupees. Again, on the bot side, three projects have got commissioned. The consolidated net debt to equity stands at 1.2 times. There is no further equity commitment is what the management has indicated towards bot projects, which definitely augurs well towards generating greater IRRs. And clearly, I think if you value the bot projects on a free cash flow to equity shareholders methodology, another 105 rupees can be added from the bot segment itself. So again, a target of 558 is something that we probably perceive on PNC Infratech, and valuations, again, as I said, generally are not too demanding, specifically on the EPC business.
Okay, fair enough, Mayuresh. We'll leave it on that note. Thanks very much for joining in and giving us all of that perspective. We'll take a break now, but up next on our Corporate Corner segment, we'll be joined by Mr. R.G. Rajan, the CMD of RCF from the fertilizer space.